Morning. So a very happy morning to everyone here. So I hope it would be understandable, it would be so much knowledgeable, and it would be so much good. Okay, so let's start today's session. Before to start, I would like to say, if you have not downloaded the Adda 247 application, download and subscribe the Officers Adda 247 YouTube channel so that you can get notifications of the live sessions, notifications of the important news that is related to your examination. So that's why subscription that is too much required, like on this channel. Okay, and download the Adda 247 application so that you can get everything at a one place. So download this and subscribe the Officers Adda 247 YouTube channel. Okay, so before to start, like today's topic, that is yield to maturity and current yield of the bond. And trust me, that topic is a very essential, that topic is a very important from the exam point of view. Okay, so let's start today's session. In this session, we are going to understand too many things and that are very essential for your examination. Like you are going to definitely get questions related to this topic. Okay, so before to start, I would like to say, if you change your mindset, that you have the ability to change your world. So I hope you will just remember this today, and let's start today's session. So before to start, I would also like to say that our target batch is started, and this is a very right time when you should just enroll in our batches, because you are going to get everything. Like you just do not need to worry what to read, from where to start your preparation. You will find everything in this batch. Okay, so I will be your AB faculty in this batch, and that batch is going to start from the 4th of April. So in this batch you are going to get everything. Like I will focus on most of the questions that you found, like based on the previous memory based questions in my lectures. Based on that, I will explain you everything. Okay, so that is your opportunity. Like you should not focus to get a 50 marks only. You should focus to get a very good marks in this examination. And this is possible because if I see like in the previous examination that held on the February, so in this, like most of the our colleagues getting 70 plus, and that's only possible by officers at the 247 faculties and your effort. Okay, so now let's start today's session, and the topic that yield to maturity, and this topic is a very important. So let's understand this. So what is yield to maturity, and what we understand by the yield to maturity, and what type of the questions actually asked in the examination by the examiner? Okay, so that's all we are going to understand in this particular session. So yesterday we actually understand what is bond. And if you have not just understand the previous day lecture, okay, so you can watch that, like what is the bond and what are the different term that associated with the bond. Meanwhile, we also discuss the type of the bond, and from that definitely 2 marks questions asked in the exam. So if you have not watched, just watch that video. Okay, so yesterday we understand what is bond, and the bond we understand, like bond is actually mostly, if I say, that is issued by the government and corporations. Okay, and that is purchased by the general public, which is just known as the investor. All right, and the government and corporation are known as the borrowers. Okay, in the case of the bond, right? So what actually, why investor investing in the bond? Because government and corporation just promises through the bond, like if the investor is going to purchase, if the investor is going to invest in this bond, and suppose that the bond value is 1,000 rupees. Okay, and the government or corporations who just issued the bond, that depends. Suppose that the government issued the bond, okay, and the coupon rate that is 10%, and the maturity period that is 3 years. Okay, so an investor invest in this bond for the 1,000 rupees, that the value of this bond, and 10%, that is in the terms of the bond, we can understand this 10% is actually the coupon rate. Okay, coupon rate, which is also known as the interest rate, and this 3 years is known as the maturity period. All right, so after 3 years, this investor is going to get the interest every year, or say on the regular interval, the interest. And after 3 years, that means that at a some date, okay, whatever the mentioned in the bond, according to the bond, like after 3 years, so on that day, like after 3 years, that interest plus principal that is going to get by the investor. Okay, so that means if any bond that having the face value of the 1,000 rupees and the coupon rate that is 10% and the maturity period that is 3 years. Okay, so for the first year this investor is going to get the interest, for the second year the investor is going to get interest, as well as for the third year is also investor is going to get the interest plus principal. All right. Okay, I hope it is understandable for everyone. Okay, so like now what is yield to maturity, what we understand by the yield to maturity. So suppose that if this investor, if this investor is going to hold this bond, if the investor is going to hold this bond till 3 years, like if the bond, this is a bond and this bond's maturity period is a 3 years, right? And if the investor is going to hold this bond till the maturity time, then what the rate of return that is earned, that is known as the yield to maturity. That's it. Okay, I hope it is understandable for everyone. Okay, so suppose that this bond, this bonds this 1,000 is a face value of the bond, this 10% is a coupon rate, this 3 years is a time period. All right, so suppose that if the investor is going to hold this bond till maturity time, then whatever the rate of return that is earned by the investor, that is known as a yield to maturity. All right, so yield to maturity, that is a total rate, total return on a bond if a bond held until the maturity. All right, so that is known as a yield to maturity. And meanwhile, yield to maturity is considered as a long term bond yield. This is also considered as a long term bond yield. This is very much important. Okay, so yield to maturity is also understood as a long term bond yield. In short, if I say it is the internal rate of return, it is a internal, which is also known as a IRR. It is the internal rate of return of an investment in a bond if the investor holds the bond until maturity with all payments, like interest is also received, like whatever the interest is going to receive by the investor before purchasing the bond. All right, as well as the principal. Okay, so that is known as the YTM. I hope it is understandable. Now understand another important topic from the exam point of view, because while study we actually skip this topic like current yield of the bond, because we think that YTM is the most important and another questions based on this or are most important. But you know, from in the question, like from the current yield of the bond, you are going to get definitely one question in the examination. Okay, and like the two question if I say, because one question that is form in the theoretical, like suppose that the formula that may be asked and as well as the question. Okay, so that is also very important to understand. So what we understand by the current yield of the bond, right? So if in the definition term I say that it measures the rate of return earned on a bond if it is purchased at its current market price. So suppose that this is a bond and this bond is currently trading at the market. Okay, so this is a market, right? So suppose that this market, suppose that this bond which is which having the value, suppose that 800 rupees. All right, and because whatever the company that issues this bond, and you know, goodwill of this company is very good in the market, or say reputation of this company is very good in the market, so that bond is just going to, you know, just going to get more attraction towards the investor. So this bond is trading at suppose that 1,100 rupees. All right, so whatever the rate of return that is earned by the investor on this bond, so that is known as the current yield of the bond, because this is based on the market price, or say current market price. All right, so I hope it is understandable. Okay, So it calculates the rate of return on a bond by using the market price of the bond instead of its face value. Okay, so whenever we have to calculate the current yield of the bond, that means we have to just do not looking for just face value. We have to look for the market value, or say market price. Okay, because it is purely based on the current market price. Okay, so it is calculated like how we calculate the current yield of the bond. So this is the formula of the current yield of the bond, that is annual interest earned, and it would be divided by the current market price or current market value. Okay, whatever you want to say. And if we have to calculate in the percentage term, so we just only have to multiply it with the 100. Okay, so like this is annual interest earned, and it is divided by the current price and or say market price, and it would be multiplied by the 100. So that would be your current yield of the firm. Okay, I hope it is understandable. So it is an accurate measure of a bond. It shows the market sentiment and investor expectations from the bond in terms of the return. So that is known as the current yield of the bond. All right. Okay. Now, another thing that is also very important, that relationship between the present value and the future value. Because when you're just going to solve the questions based on the bond, you are going to get different type of the questions, and from where you should definitely know the relationship between the present value and the future value. So you have to understand that is future value that is equal to the present value, and this would be multiplied by the 1 plus r to the power. Okay, so you are going to get a question from that, like what like questions are there, and you have to calculate the future value in terms of the present value. All right, and if I say that we can also write this like present value that is equal to the future value, and it would be divided by the 1 plus r to the power n. So this is the relationship between the present value and the future value. Okay, I hope it is understandable for everyone. So this formula is going to is going to very useful for you in terms of solving the question, and this formula will be useful in the chapter of the bond, in the chapter of the capital budgeting, in the chapter of the capital budgeting, as well as for solving the annuities question. Okay, so you can understand how important this formula is. Okay, so there is nothing so much to memorize here. You just only have to understand that is future value that is equal to the present value, and it would be multiplied by the 1 plus r to the power n. All right, so this is how we this is the basic relationship between the future value and the present value. Okay, so I hope it is understandable. Now one more thing I would like to convey here, after that we are going to solve the questions. Okay, so another thing that is important, that is present value interest factor and present value interest factor annuity. Okay, because in this chapter you are going to get like questions where the this value is given. Okay, so you just have to know what the meaning of the PVIF and the PVIFA. So PVIF, this is also known as the present value interest factor. Okay, and what we understand by the PVIFA, that is present value interest factor annuity. All right, so this is the formula of the PVIF and PVIFA. Okay, so what we understand by the PVIF and how we just calculate this, so PVIF is a formula that is used to estimate the current worth of a sum of the money that is to be received at some future date. That's it. And it is based on the key financial concept of the time value of the money. So what is the PVIF? That is nothing. It is a formula that used to estimate the current worth of the sum of money that is to be received at the some future date. Okay, so that is known as a PVIF, that is present value interest factor. Okay, the same thing we can understand like this, like what I said, that this formula, if I'm talking about the PVIF, like this formula is used to estimate the current worth of the sum of money that is to be received at the at some future date. Okay, so that means we can also understand, like whenever we have to calculate the present value interest factor, that means we can also use this formula. Okay, that's why I just, I just explained you the relationship between the present value and the future value. Okay, so I hope it is understandable. And what we understand by the present value interest factor annuity, so whenever, if you just watch my lecture of the annuity where I just explain you, whenever you see the term that is annuity, annuity is nothing but the series of the payment. Okay, annuity is nothing but the series of the payment. And whenever we are just looking for the series of the payment, like interest is going to receive at the regular interval, that means whenever the same interest is receiving at the same interval, that is considered as the annuity. So whatever the value we have to write in terms of the present value interest factor annuity, we have to multiply with this. And when we are going to get the one time principal, like, so we have to multiply with this, and we will understand better in terms of the question. All right, so now the question we are going to solve. Now the question is, I would like to say, first just read the question, and after that we are going to solve. Okay, so first read the question, like I explained you what is the formula of the current yield of the bond. So just write on the paper. Okay, so current yield of the bond, like I just explained you what we understand by the current yield of the bond. And the name itself is, name itself just implies like current yield of the bond, that is related to your market price, or say current market price, right? So the current yield of the bond, that is equal to what? That is equal to the annual interest earned, and it would be divided by the current market price. All right, and the in the bond, when I just explained you the bond, okay, in the previous lecture, I explained you, whenever you will see like like the face value is given, like the face value is given, and the coupon interest is given. Okay, so coupon interest rate is given, like 8% given is here. Okay, so you just have to multiply with this. By this you are going to get the annual interest earned. Annual interest earned. So how many of you are just remembered, like yesterday I explained you, that you have to remember that whenever you are just going to get the face value and the coupon interest rate, because in the examination there are multiple interest rate may be given, so you just do not need to confuse like what interest rate you have to apply. So you have to apply the coupon interest rate. Okay, so from that I also explained you the zero coupon what we understand by the zero coupon interest rate. Okay, so what we understand by the annual interest earned. So how we can calculate this? This is quite simple, that we have to multiply with the 8% to the face value of the bond. So that would be equal to the 80 rupees. So this is your annual interest earned. All right, so from that we can write here, that is the 80 rupees here, and the current market price, which is 800, which is 800. So just write here 800, and for getting the value in terms of the percentage, we have to multiply with the 100. So that value will be equal to your 10%. So that would be your current yield of the bond. So this is how we solve the questions of the bond in the examination. All right, so I hope it is pretty much understandable for everyone. Okay, now we are going to understand a very important question, because you are going to get these kind of the question definitely in the examination in the 2 marks. Okay, so we are going to just understand how we can solve these kind of the questions in the examination with a very short method. Okay, so we are just going to understand. Look, what I explain you, First read this question. After that, I will just going to explain you how you can solve this question. So the question is a bond with a face value of 1,000 rupees. So this is the your face value is given for the bond, which is 1,000 rupees, and it bears a coupon rate of 12%. So if it bears a coupon rate of 12%, so you just you know that whenever the coupon rate and the face value is given, what you have to do from that, you can easily determine what the annual interest earned by the investor. So that is 1,000 rupees, and it would be multiplied by the 12%. Okay, so from that, what if I say what the annual interest that would be earned by the investor, so that would be equal to your 120 rupees. So that would be the annual interest earned by the investor. Okay, and now the maturity period, which is given 3 years. That means this interest the investor is going to receive in the first year, this interest the investor is going to receive in the second year, this interest the investor is going to receive in the third year, as well as in the third year the investor is also going to get this 1,000 rupees, which is invested by the investor while purchasing the bond. I hope it is understandable. So I hope it is understandable for everyone. So here the required rate of return on the bond is 10%. Like I explained in the definition of the YTM in the current yield of the bond. Like what I explained in the YTM, that the total return on the bond if the bond is held until it matures. So what we understand by the total rate of return, the actually the investor is just going to get the 10% rate of return. That's it. Okay, so that is known as a your required rate of return. Okay, and now we have to calculate the value of this bond, or say present value of this bond, in terms of the future payment. So this is the future payment that is going to receive in the future. So we have to calculate the present value of this bond. So how we can calculate? So we know that 120 rupees that is going to receive in the future. So how we can write this? That is 120, and it would be divided by the 1 plus required rate of return, that is given 10%. So just write here 10%. Okay, and because this is for the first year, so the value of that would be the 1. All right, for the second year if I say, so that would be equal to the 1 plus 10 by 100, and now the value of the n, that would be the 2. Okay, because this is for the second year. For the third year, this would be the 120 plus 1 plus 10 by 100, and it would be the power of the 3, because this is the for the third year, as well as plus 1000. Okay, so either you write the separate 120 divided by the 1 plus 10 by 100 to the power 3, or you can also write in this way. Okay, now you can see this this equation is going to more complicated. Okay, so for solving that, we understand like the PVIFA. This is understandable as a present value interest factor annuity. Okay, so in terms like, instead of writing this, if the value is not given in the examination, like PVIFA is not given, so you can definitely solve by this, like using the calculator. And if it is given, so this is a very important tool. Okay, so how you can just write, because of PVIFA, that you understand that the present value interest factor annuity, and what we understand by the annuity, that is series of the payment. That means 120, that would be multiplied by the PVIFA, present value interest factor annuity, which is a 10% for the 3 years. The value is given here 2.487. So you have to multiply with this. Okay, and for the 1,000 rupees, because this is a one time you are getting, this is not the series of the payment you are getting, this is a one time. So you only have to multiply with the present value interest factor, that is the 0.751. Okay, now just tell me what will be the value here you guys are getting for this. So 120, that multiplied by the 2.487. So what will be the value? Just tell me what will be the value of this. So the value that you are going to get 298.44, right? That you are going to get, plus this would be 751. So the answer, if you just sum up this, what you are getting here, that would be equal to the 1049.44. So that would be your answer for this question. So this is how we can solve this kind of the questions in the examination, and this is a very important question, like you are going to get in the examination. I hope this is understandable for everyone. Okay. So now I am again just showing you how you can just enroll in our batches, and this target batch is very important because you are going to get everything in this batch. So I hope you guys just enrolling in this target batch. And in this target batch, the very important thing that you all are getting the questions, you all are just going to get the material that actually the based on the previous year memory based question. So that is very important thing to understand. Okay, so now I'm just showing you how you can enroll in our target batch. So the first thing that you have to just visit the adda247.com JIB exam kit, okay, where you will find multiple batches that actually running and that actually scheduled for your examination. And you will find multiple batches of the bilingual batches as well as the English medium batches. Okay, so you can also purchase, you can also enroll in the individual subject, like if you just enroll in the PPB, in the AFB, in the LRB. So you can also enroll in the you just have to just visit the view all, and after that you can just able to enroll in any individual batches. Okay, so if you just want to enroll in the target batch, suppose that, okay, so in the target batch, if you just enroll, like you will get a mock test, ebooks, as well as a live classes. Okay, and you know how you can enroll in this, like you have to just click the buy now section, and in the buy now section you have to apply the code, that is Y422, and you will get a big discount from this code. Okay, and now just think that flat 77% off you will get by applying the code, that is Y422. Okay, so this is how you can enroll in our target batches, as well as you can just apply this code in any JAIIB and CAIIB product, and you will get the big discount on that. Okay, so that's all for this session. I hope this session is useful for everyone. So if you're liking our effort and content, do not forget to hit the like button on this video and share this video to your friends, your colleagues, so that maximum number of our colleagues can join with us. Okay, so once again, thanks for watching me here, and please do not skip this opportunity. Just grab this opportunity, because in this June session I just